Assalamualaikum, my name is Bint-e-Atif. Welcome to Smart Commerce classes. Sorry for the delays in the videos. Today we are doing 7707 accounting paper of October-November 2022, 12, paper 1, second variant. Which transaction will increase both assets and capital by the same amount? First, we need to know that capital is increased when there is an increase or decrease in profit. For example, if there is an increase or decrease in expenses or income, so the capital will be increased. So the first option is a credit customer settled his account after deducting a cash discount. That means that a credit customer trade receivables will be debit. That means that it is the trade receivable have been finished as he has given us the cash. So the trade receivable will be credit, cash will be debit along with the discount allowed. So these item increases and decreases asset. So there is no adjustment in the capital. So A won't be the answer. B option is goods were sold for cash at a price higher than their cost price. That means that the sale price is higher than the cost price. That means that the profit will increase. So B will be the answer. C option, rent received included an amount prepaid for the next accounting period. As we know that the prepaid rent received is the income that includes prepaid. That means the extra amount that is received, which we haven't rendered any service, that is included in our income statement. So we have to deduct this prepaid. So in it, no asset is involved, only capital is involved, as the profit will be decreased by prepaid amount. So only capital is involved. So in B option, capital and asset are both increased by the same amount. Okay, on 1st June 2021, Sue's capital account had a credit balance of 120,000. During the year ended 31st May 2022, she withdrew goods costing 1,800. The loss for the year was 1,4,200. What was the credit balance on Sue's capital account on 1st June 2022? On 1st June 2021, it has the balance BD, opening balance of 120,000. So in capital account is affected by profit and drawings. So we have opening balance of 120,000. During the year, Sue withdrew goods costing 1,800. That means that drawing is 1,800. So 120,000 drawing will be deducted, 1,800 will be deducted, and the loss for the year. Profit increases capital and loss decreases capital. That means 120,000 minus 1,800 minus 1,4,200. So the answer will be 1,0400. Moving towards third question. Bilal purchased goods on credit from Asim. That means Bilal has purchased goods from Asim. Bilal is a customer that has purchased goods from Asim, a supplier. So where should Asim record? That means where will Asim, a supplier will record his transaction. For Asim, it will be sales. So he'll record this in the sales ledger, and trade receivable ledger that will come under nominal general ledger. So 2 and 4, D is the answer. Okay, moving towards fourth adjustment. Abdul sells goods to Rekha on credit. Some goods were damaged in transit. Which document would Rekha send to Abdul? Abdul sells goods. That means Abdul is a trade. Abdul sells goods. That means Abdul is a supplier who sells goods to Rekha, a customer, on credit. Some goods were damaged. That means Rekha needs to send some document to Abdul for return. So Rekha is a customer. Customer is sending any document to Abdul, that would be debit note. If the confirmation is made by the Abdul and Abdul sends any document to Rekha, that would be credit note. So B is the answer. What is not shown on an invoice? amount of trade receivables, date payment made, details of goods supplied, and D is terms of payment. In invoice, amount of trade discount is given so that to calculate the to calculate the discounted price or the amount that should be recorded in the records or in the journal entries. Date payment made, the date is not included in the invoice. Details of goods supplied is included, terms of payment and discount, trade discount that is given will be written in invoice. So B would be the answer. Sixth question is, on 1st September, Peter sent a check to his credit customer. Peter is a customer that has sent a check to John, a supplier. This was correctly entered in John's book. On 10 September, the check was returned unpaid due to lack of funds. That means what adjustment? As it is written that Peter sent a check. Peter has sent a check and that was correctly entered in the John's book. That means that John have written that bank debit and trade receivable Peter would be credit. So on 10 September, the check was returned unpaid. That means there was a dishonored check. The check didn't clear. So it will reverse the entry. Peter will be debit and bank will be credit as we haven't received any payment. Question 7. Which entries should be made to post the monthly totals of the discount allowed and discount received column of the cash book? Discount allowed is an expense, a discount received is a income. So, credit discount allowed column, which entries should be recorded to made to post the monthly totals of the, okay. It would be, will debit the discount allowed account and credit the discount received account. Okay, moving towards question 8. Jaswinder maintains a petty cash book using an impressed system. The monthly impressed of 100 is restored. Impressed amount is that every month 100 would be at every month start, and every month start we'll have 100 in our petty cash book. So it's written, in September, the petty cash showed the following. Total expenses 83, total receipt 7. So the answer would be 83 would are the expenses. That means we have impressed 100. So what do you need to restore? Okay. We have 100 opening balance, total expenses. That means 83 were spent. 100 minus 83 would be 17. And the total receipt is 7. That total receipt that came into our cash book was 7. So the answer would be 83 minus 7. That would be B, 76. We need to restore that. As we had 100 previously in our petty cash book. Total expenses 83 were cash outflow, and total receipt 7 was cash inflow. So we need to add 76. We need 76 in our account on 1st October. More. Okay. 9. Sadiq trial balance failed to balance. The debit column totaled 12250 and the credit column totaled 12200. That means there's a difference of 50. The following error were discovered. No entry has been made for cash book. Cash sales 150. That means this is the error of omission. 150 cash cash debit, sales credit. So the total of the discount received amount 50 had been omitted from the trial balance. That means only the discount received column account total have been omitted, 50. Discount received is an income, so it will come under credit side of the trial balance. And sales 150 will also come in the credit side of the cash trial balance, and cash debit. Cash will come under the debit side of the uh, trial balance. So will total debit balance would be 12250 plus 150. That will give us 12400, and the credit column would be 12200 plus 50 plus 150 of the sales. That would give us 12400. So what are the total? What are the total of the trial balance after the errors correction? That will be 12400. Okay, moving towards question 10. 68 paid by the credit transfer for insurance was entered in the accounting record as 86. We have recorded wrong. We have recorded wrong amount. 68 that was paid to the credit transfer for insurance was entered as 86. So 60, and that means we have recorded 86, 18 amount that is recorded more from the actual amount. So we'll reverse the entry. As for example, the entry would be insurance debit that is paid through bank. So the bank would be credited. As we have written an increased amount. So we'll reverse the entry by the difference. That means bank would be debited and the insurance would be credited. So moving towards question 11. Question 11 states that after the preparation of her income statement, Emma discovered the following errors. A debt 1500 has been written off as irrecoverable. No adjustment had been made for rent prepaid by Emma of 2800, and the draft profit would be 35,000. So from the profit, a debt of 1500, that is irrecoverable debt. That means bad debts will be deducted. 35,000 minus 1500, that will give us 35,000 minus 1500, that will give us 33,500, and no adjustment has been made for the rent prepaid. Rent is an expense that is prepaid. That means 2800 will be deducted from expenses and increase our profit. That will increase our profit by 2800. A debt that is irrecoverable debt, that is expense that will be deducted from 35,000. That means 35,000 minus 1500, and a rent prepaid. When expense is prepaid, so the expenses are deducted and the profit is increased. So 2800 will be added to 35,000 minus 1500. Okay, the answer will be 36,300, C answer. Then we have Hamid purchased a motor vehicle from an overseas motor manufacturer. Which expenditure relating to the motor vehicle is the capital expenditure? Okay. First, D option, replacement tires. Capital expenditure means that if we spend on the non-current assets, and it will increase our worth of the business or the asset. So when we'll replace the tire, the old tire will be replaced by the new tire, so the worth will be maintained. So that will be the revenue expenditure rather than the capital expenditure. Petrol is the expenditure that is done daily or monthly. So it won't be the capital expenditure, it will be the revenue expenditure. Or if there is any repair, so that will be a revenue expenditure. Insurance is done every year, so that would be revenue expenditure. Delivery charge, that is done only when the asset comes in the business. That means the carriage inward or carriage outward. A transportation cost, that will be capital expense. That will be part of the capital from asset cost. Question 13. When Tile purchased a motor vehicle for 35,000, he estimated it would be used for 5 years and then sold for 5,000. When Tile depreciated the motor vehicle using the straight line method at a rate of 20% per annum, what was the accumulated depreciation on this motor vehicle at the end of year 2? Okay, in year 1, he purchased a motor vehicle of 35,000, and he estimated it would be used for 5 years and then sold for 5,000. 5,000, that is the net book that will be residual value, and the useful life is 5 years. So in Ventile depreciated the motor vehicle using the straight line method at a rate of 20% per annum. So we'll do 35,000. It would be 30,000. Okay. As it is written that 35,000 is the cost, 5,000 is the residual value, and useful life is 5 years. And it is also given that straight line method, it uses straight line method at a 20% per annum. So if we are given with these two statements, that useful life is also given and the depreciation rate is also given at a straight line method. Remember, from this on the straight line method. So we'll always use the residual value and the useful life, not a percentage. So we'll do that 35,000 is a cost minus the residual value 5,000, that will give us 30,000, and the use divided by the useful life, that is 5 years. We'll divide 30,000 by 5, that will give us 6,000, and it is written that what will be the accumulated depreciation. Accumulated depreciation is the total depreciation that would be at the end of the year 2 of the motor vehicle. That means in year 1, we'll have a depreciation of 6,000, and at the end of the year 2, we'll also have 6,000, but the total depreciation of year 1 and year 2 will be 12,000. So for the 13 question, the answer would be B, 12,000. So moving towards question 14. On the first day of his financial year, Justin purchased a new machine costing 20,000. 20,000. On this date, his old machine had a book value of 6,000. Justin was allowed 4,500 for the old machine. In part exchange, he paid the balance by check. Machinery is depreciated at the 20% per annum. That means at 20,000 first day of the financial year. That means 20,000 into 20%. 20,000 into 20%, that will give us. Okay, wait. As it is written that Jason purchased a new machine costing 20,000. So the 20,000 will charge 20% depreciation. That will be 20,000 into 20%. That will give us 4,000. And it is written how much should be charged to Jason. It is not written that what would be depreciation that will charge in the income statement. So in the income statement, as it is written on that date, old machine was also sold for 6,000 and it was allowed 4,500. That means cash. That was 4,500. That was received in terms of selling 6,000 asset, 6,000 cost asset. So it is written that total charge in income statement, we also charge the profit and loss on disposal. So 20,000 into 20%, that will give us 4,000, and net book value of asset of 6,000 that was sold for 4,500. That means there was a loss of 1,500, as depreciation is an expense and the loss on disposal is also an expense. So the total charge means that the expense, and if there is written any credit to the income statement, that means there is a income. So it is written charge. That means 6,000 minus 4,500, 1,500 loss plus 20,000 into 20%, 4,000. That means 5,500 will be the answer. Moving towards 15 question. Maratha rents out part of her business premises on 1st September 2021. She was owed rent of 1,500, and on the 31st August 2022, she was owed 1,800 rent. During the year ended 31st August 2022, Maratha received a rent of 6,000, and how much was transferred to Maratha's income statement. That means we have to calculate the income rent that will come under income statement. So she was owed rent. She rents out part of them. That means she receives a rent. That means it is an income. So 1st September 2021, on balance PT, she was owed rent of 1,500. That means that it is an asset. 1,500 will come under in rent account. Okay, in rent account. in rent account, there will be a debit of 1500. And she was owed 1800 on 31st August 2022. That means there is a balance CD of 1800. Okay. Okay. During the year, Maratha received rent. That means bank took rent. That means in rent account, 6,000 will come under this. A bank entry that will give us 6,000 plus 1800 minus 1500. That will give us 6,300. 6,000 plus 1800 minus 1500. That will give us 6,300. That will come under the income statement. So moving towards question 16. Parker receives, okay, moving towards, wait for a minute. Okay. Question is 16. Parker received cash from Alexei for a debt that has been written off as irrecoverable. As previously, it was written as irrecoverable debt. That means trade receivables will bad debt to trade receivable. Bad debt will be debit and trade receivable will be credit. So Parker received the cash. So we received a cash. That means bank to trade receivable. Trade receivable was previously also credited. So we'll only change the bad debt account. We'll only move the bad debt account. That means that cash in previously it was written that bad debt to trade receivable. Now we have to write cash to trade receivable. Trade receivable is written in the right column. So we'll only adjust the bad debt. So the bad debt was previously debited. Now it will be credited. So in which account it was written recoverable debt will be credited and cash that is received will be debited. So for 16, it is B, that debt is recovered. Irrecoverable debt, we won't be crediting the irrecoverable debt. If we credit the irrecoverable debt, so it will be income. So debt that is recovered. Previously, it was irrecoverable. Now it is recovered. So the debt recoverable will be credited and the debt and we'll debit the cash account. So we have question 17. Why should inventory be valued at the lower of cost and net realizable value? A, to avoid undervaluing of the inventory. Okay, if we'll value our inventory at lower of cost or net realizable value, so so our inventory won't be undervalued, it will be overvalued if we won't be recording it at lower of cost, as we'll always record the inventory at a higher price if we are not using IS2 or the NRV chapter. We're not using that NRV or lower of cost. B is to comply with the historical cost. Historical cost is the cost that we record our asset at a cost price that we purchased, not on the fair value or realize the revaluation amount. Okay. C is to comply with the principle of material. Materiality is a concept that we only write the amount that is important. So the lower of cost and net realizable value don't come under historical cost or the principle of materiality concept. So the D option is to ensure the profit are not overstated. That is the right answer. As if we record lower of cost or net realizable value, if the closing inventory or the opening inventory won't be recorded at the lower of cost or net realizable value, so the profits will be understated or overstated. So D is the answer. Okay, Allah Hafiz. Okay,